What exactly was the key takeaway for you from these tests? Is it as big of a deal as we think it is right now in the markets?
Yeah, I think it is a big deal, and the challenges that banks face and the economy faces can't be overlooked. But at the end of the day, we continue to believe that this is an earnings issue as opposed to a capital or liquidity issue. The Fed has obviously taken unprecedented measures to help bolster the system through lending facilities, PPP, et cetera. And at the end of the day, this gives, we think, credibility to banks' ability to be able to weather the storm. Having to go through another round of stress tests later this year, we think will add additional confidence that the banks are well prepared to navigate what are very choppy waters.
So Michael, I'm curious because over the course of the past several months and perhaps even years, let's say, we've known that the banks in America are better capitalized now than they've been in quite some time in the wake of the great financial crisis. Yet investors have not been nearly as bullish or optimistic since the end of the great financial crisis, and certainly not as much during the recovery of the COVID-19 pandemic. What exactly is getting in the way of investors saying, I want to buy banks?
Yeah, it's a great question. This was clearly the longest recovery that we've had, going back 100 or so years. And, I think as we got later in the cycle, there's this fear that credit losses would materialize at some point and we would have a recession at some point. I don't think anybody anticipated it would happen as quickly and as sharply as it did with the COVID-19 pandemic. But I think what we've seen is, banks are going to be a source of strength during this recovery, where they were kind of the root of the cause during the great financial crisis.
So with that in mind, you have a fairly wide coverage universe there. What exactly, banking-wise or financial services-wise, will be the strength, the relative strength in this kind of environment, and what types of banks could fare the worst if we were to see a so-called W or double dip type recession scenario?
Yeah, so in the near term, it's going to be all about loan loss provisions and credit losses. Just given the amount of government support and stimulus that's been thrown at the issues at hand, we won't know what ultimate credit losses look like likely until later this year and into next year, as things like the EIP and the PPP kind of run their course, and then we get the more normalized stimulus coming off. But I think at the end of the day, what I'd really want to drive home again is that banks remain very well capitalized, pretty solid pre-tax, pre-provision earnings, and we'll likely see a peak in those loan loss provisions over the next quarter or two, and then we'll see from there. But we're looking for banks that have strong capital positions, again, strong pre-tax, pre-provision earnings. From an investment point of view, we're recommending a barbell approach where we have a basket of safety names. But also, if the recovery does continue in a more V-like shaped recovery, a basket of beta names. Those that maybe are a little bit lower on the quality spectrum or have a little bit lower capital levels to take advantage of what are pretty depressed prices at this point.
Just before we let you go quickly, Michael, what types of names then go on the barbell, the quality side and the kind of more betting on a recovery side? Yeah,
so on the defensive names, we're looking for, some of the mid-cap banks like a Prosperity or a Home Bank Shares. And then on the beta side, names like TCF, Regions, and then Wintrust are names that we would recommend. Those are in the mid-cap space, which is the majority of our coverage universe.